Hey guys, so welcome back to the channel. Today I have a new trading strategy which I'm going to backtest for you over 100 trades. I will first tell you about the 3 indicators that we're going to be using, show you a few examples, and then perform the 100 trade backtest. So the 3 indicators are the MACD, the RSI, and the Stochastic. And make sure you watch the whole video because the results are really promising. So the moving average convergence divergence, also called MACD, is a trend following momentum indicator that shows the relationship between 2 moving averages of a security's price. The default settings are calculated by subtracting 26 period exponential moving average from the 12 period EMA. However, this strategy has slightly different settings for the MACD. The second indicator is the Relative Strength Index, also called RSI, which is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or another asset. The RSI is displayed as an oscillator, which is a line graph that moves between 2 extremes and can have a reading between 0 to 100. And the third indicator is the stochastic oscillator, a particular closing price of a security to a range of its prices over a certain period of time. The sensitivity of the oscillator to market movements is reducible by adjusting that time period or by taking a moving average of the results. It is also used to generate overbought and oversold trading signals, utilizing a 1 to 100 bounded range of values. So this backtest is based on the 1-hour time frame with a variable stop loss and take profit settings. So here's the strategy. We go long when the RSI is above 50, the stochastic is oversold, and the MACD is trending upward. And similarly, we go short when the RSI is below 50, the stochastic is overbought, and the MACD is trending downward. Second rule is that we place the stop loss at the last swing. We don't have a maximum number of trades that we can have open at all times. And the last rule is that we take profit when the stochastic and the RSI are oversold for short positions and overbought for long positions. So let's get on the charts now so I can show you a few examples and then we'll dive into the backtest. All right, so here we are on the charts on GBP USD on the 1-hour time frame. So we'll go ahead and add the indicators. So we've got 3 indicators today. We've got the stochastic indicator, got the MACD indicator, and the RSI. So there's a slight change in the settings. In the RSI, we'll leave it like this. You can change the colors if you want. But MACD, we've got 8, 25, and 5. The RSI, we can just remove that moving average. We can leave it to 14. All right, so the first point of reference is the stochastic indicator. When the stochastic indicator is overbought, which means it's above the 80 line, we are looking for short positions. So we take a short position after the stochastic has reached a value of above 80. The MACD needs to be trending downward and the RSI needs to be below, which means that in this case, it would be exactly at that candle. So we would go short right here, place a stop loss at the last swing, and then we would close the position next time both stochastic and the RSI are oversold. In this case, it would be after this candle, which would give you a 1 to 2.5 risk to reward ratio. So that's pretty good. I'll show you a few examples and then we'll dive straight into the backtest. So here's a perfect example of a short trade. We've got the stochastic that has reached an overbought state, the MACD that is trending downward, and the RSI closing below 50. So we enter here, we place the stop loss at the last swing, and we wait until both the stochastic and the RSI become oversold, which is right after this candle. However, after this, we've got an oversold stochastic, so we are looking for a long trade. The MACD needs to be trending upward and the RSI needs to be above 50. So we wait until it happens, which is on this candle. However, we are not entering a long trade simply because the stochastic has reached an overbought state. So essentially, this is the only exception where we wouldn't get in the trade, is if the stochastic has reached the opposite state of which we will base the initial trade direction from. So let's go ahead and do the back test and I'll see you for the results. So here are the results, guys. On GBP USD, we had a maximum drawdown of 14%. We were risking 5% of the account per trade. We had 43 wins, 22 losses, and 34 trades that ended up in break even. We had a maximum of 3 wins in a row and 3 losses in a row. That gives us a win rate of 66% over 98 days. So over slightly more than 3 months, we generated a total profit of 374.2%. So if you would have started with $10,000, you would have ended up with slightly more than $37,000. So that's a great strategy. As you could see from the back test, it's very labor intensive. So I think some of it could be automated so that it just sends you signals when the conditions are met. That's something to think about. And I think the time frame could be changed to a lower time frame, I think, for a bit more fast pace and more trades. With the variable risk to reward ratio and the low drawdown, I think that creates a really good strategy. So let me know what you guys think in the comments, and I'll see you in the next video.